Good morning, everybody. Thank you so much for joining us today for our March edition of Coffee with Forethought. We're happy to have you here. While everybody's joining us today, just a quick reminder as far as our disclosures go, everything we're about to talk about for informational purposes only. Please do not take any of it as personalized financial advice. If you do have any questions for us or the team here at Forethought, please reach out directly to talk about your situation, and you can see our website for full disclosures there. Also, before we get going here, we are doing a live Q&A at the end of this. We would love your participation throughout. So at the very bottom of your screen, you should have a Q&A dialog box or just a button down there. Feel free to type in your question as we go through our presentation today. Whenever you think about it, go ahead and type it in there, and we will get to as many as we can during our Q&A session. If for some reason we don't have time to get to all of the questions, we will for sure have somebody reach out to you and make sure that your question still gets answered, even if it's not during our session today. So, for those of you who have not joined us before, my name is Joel Johnson. I am the Director of Planning here at FourThought Private Wealth. Happy to be with you today, and I am joined by Jake McFarland, who is our Senior Research Analyst. Jake, how you doing today?
Good morning, Joel. Doing well. It's crazy to me that we are already in March, and yeah, we have a lot to talk about for February, don't we?
Yeah, you're not kidding. We got some things that hit the headlines. We got a lot to touch on, and the fact we're already in March blows my mind, but here we are nonetheless. So let's dive right into it. We got a lot of things that we want to talk about today, so we're just going to start right off the bat on what were the key events, what were the key headlines that we saw in February that we wanted to make sure that we talked about today. And we had quite a few of them. So we'll go through each of these one by one, kind of provide our thoughts. And let's start off, Jake, with the tariffs. And the Supreme Court came out finally ruling on the tariffs that were put in place almost a year ago now, back in April last year. And that has gone through a bunch of different iterations over that year period where we were fighting this out in the court system on whether or not they were even legal to begin with. And what the Supreme Court finally came down and decided was that they were not, and that the tariffs were not allowed under the current Constitution. That was not a power that the president unilaterally had to make. The power of the purse did, in fact, sit with Congress. And so that was a big blip in the overall markets for a few days. And there's a lot of things we can talk about there. But Jake, give me your initial thoughts on what happened with that tariff decision and what you think we might see from that moving forward.
Yeah, I think it's a major decision. I mean, it certainly invalidates key parts of the administrative's emergency tariff regime. And I think if we look at kind of where the average tariff rates are now versus, before that court ruling, we see a lower tariff rate. And I think we saw a little bit of a rally within the equity markets, kind of on the basis that this regime uncertainty around tariffs will probably ease into the future. In other words, that the president doesn't just have that power to make kind of broad-based tariff policy decisions. And I think it's also probably going to be good for inflation as well. I mean, we heard a lot that these manufacturers and these companies will have to pass along these increased prices as much as they can possibly do without kind of harming their business, and kind of the end consumer is going to feel that in increased prices. We hadn't seen a whole lot of that. I think these businesses were still trying to see exactly what the effect would have. But now that a little bit of this uncertainty goes away, I think that will be a benefit to inflation as we look forward.
Yeah, and this is one of those things that's going to be an ongoing issue that we have to keep an eye on. The initial rhetoric out of the White House was, okay, the 10% tariffs we had in place, now they're moving to 15 under a different segment of the tax code or whatever the law is that we're trying to get that passed under. So this is going to be an ongoing thing that we're going to have for many, many months to come. The other thing that I noticed or that we're starting to see is that companies that were affected by these tariffs that have been paying these tariffs for the last 12 months, they're now starting litigation against the government to try to get refunds for those tariffs. If they were illegal to begin with, why is it fair that they paid them in the first place? And so there's not going to be any quick resolution to any of that. I think you hit on the great points there around inflation, especially towards the consumer, whether or not these companies are going to be able to pass on those tariffs to the consumer. All of that is still very much up in the air, but at least we have the first concrete step in hopefully getting some sort of resolution to this tariff battle that has been going on now, like I said, for almost 12 months at this point. So certainly a story we're going to keep an eye on, make sure that we keep everybody updated on that. But again, for kind of the first step towards a resolution there. The other big thing was we've been in earnings season, and Jake and the team have been heavily digging into these earnings calls, looking at the reports, checking in on the financials of these companies. And we're going to dig into a few specific companies in just a few minutes. But I did want to spend some time and talk about the jitters that we've seen in the market around these earnings, just at a high level, and what I'm calling the AI premium here, which is essentially that if you had AI anywhere in your earnings report, which almost everybody did, if it was involved in your name, if you were a chip manufacturer, doesn't matter. Anything related to AI over the last 12, 15 months has had a premium multiple in the market. They were getting bid up because of that AI premium. And I think what we might be starting to see is a fading of that premium. So these companies are going into these earnings reports what I would call price for perfection. They need to have blowout earnings. They need to hit on every single metric. And even then, if they do all of that, it still might not be enough. And you'll see a slight decline in the stock price after earnings. You're going to see a broad swath of companies reporting earnings, and they're going to have very disparate reactions to those earnings reports. But we might be starting to see the reduction in that quote unquote AI premium moving forward starting this quarter. And like I said, we'll be touching on a couple of other earnings reports in just a second. But Jake, any thoughts on that?
Yeah, I think one thing that's very interesting is when you look at like the management commentary that comes when a company announces earnings. Joel, you kind of hinted at this, but over the last 2 years, it was almost like if management wasn't talking about AI in their discussion, then like they're not a part of the cool kids, or like they're going to get penalized for that. And now we're starting to see that flip in the other direction. I mean, we'll talk about some specific companies, but I think just broad based, investors are really getting very skeptical about these AI initiatives and want to see like what profit are you driving from these AI capital expenditures or these AI investments. And
Mhm.
I think that when coupled with stocks trading at pretty high multiples, I agree with you, Joel. And it also, there is a function that corporate earnings and corporate profits have been extremely strong. So it's very interesting where you're getting
Yeah.
these great companies that are making, investments into projects that will hopefully spur future growth, but they are executing, they are having strong profits, and a lot of them are starting to get penalized. And so, yeah, I couldn't agree with you more. The other kind of trend that we're starting to see is capital being returned to investors. And it kind of goes alongside with what we've seen in earnings results. We've seen robust capital return via dividends and share repurchases from these companies. And a lot of them are really trying to give their excess cash flow or their excess earnings back to investors. A lot of them are pursuing pretty high buyback programs, and essentially what they're saying is this is a more defensive kind of pillar when growth is maybe a little bit more uncertain. And if you're an investor, you like for a dividend, you can in most instances, count on that dividend being paid, even if the stock is, not doing so well. So you might have maybe a negative price return, but you still have some income that's coming in. So I think, what we're seeing now is maybe a pullback in some companies from, invest in the next growth opportunity pretty aggressively, kind of maybe taking the foot off the gas a little bit. But I think it does signal some confidence in their balance sheet and even their commitment to shareholder value. I think these are good things that we're starting to see. But it doesn't exactly surprise me either that maybe we're seeing some negative reaction and some increased volatility as some firms are shifting their narrative, right, from growth
Mhm.
in AI to maybe a little bit more defensive posturing.
Yeah, wholeheartedly agree with you. And we love seeing the capital return to shareholders, whether it is through a dividend or a share buyback. We don't care. It's good. What we care about is whether or not the company is being efficient with their capital. And if they think buying back shares is the best way for them to deploy these earnings, because you're right, they are executing. A lot of these companies have record earnings. Margins are still good, if not improving, because of AI in the short term here. So if they think the best use of their capital is to start buying back shares from the public markets, that still benefits shareholders overall, just in a different way than a direct dividend, right? Which is, I think, is what most people are most familiar with when we talk about returning capital to shareholders. But it's certainly a theme we're starting to see more and more of, and one we're keeping an eye on, because if the company's looking at their current stock price, you've seen big pullbacks and some big names. That could be a very efficient use of capital, and we're starting to see that. So it's a good thing to keep in mind over really probably the rest of 26 and moving into the future here. Now, the big topic, we saved it for last year on our initial slide to talk about, but of course, this is on the top of everybody's mind, is what happened over the past weekend with the military action that started in Iran. And I'm going to preface this very strongly with Jake and I are by no means geopolitical experts. And what we want to make sure that we focus on is the investments and how this military action might affect your portfolio. And so we've been doing a lot of research and reading about this topic over the last couple of days. And our thoughts on it are, we just sent out a video from our CEO. If you haven't seen that, would highly encourage you to take a look at it as well. But what we're thinking as of right now is this is hopefully going to be a short-term military action in the region, and it should not have widespread effect or long-term effect in the overall markets, again, from the investor standpoint moving forward. Now, that being said, there is still the tail risk that it does drag out longer than we expect it to, and it could have more significant impacts. But for right now, we think that most of it has been baked in. Last summer, we had that initial action in Iran that kind of signaled to the market that something might be happening here. The market is a forward-looking machine, and so they had been pricing this into the stocks that could potentially be affected already. I think we have seen that. And I think that's also why you saw the reaction that we did this week, which is some downward movement, but not significant in the way you would typically think with military action going on in the world or geopolitical risk. Looking historically, things like this tend to work themselves out in the market over about a 6-month period. And so we're keeping a very close eye on it right now, but we are not making major portfolio decisions or changes. But please, if you have any or want to have a conversation about your portfolio, we want to make sure that we go back to first principles of portfolio management, making sure you have enough cash and fixed income in your portfolio to get through this in case that tail risk does happen. Now, the one big part of the market that has been affected, of course, is oil. We're seeing big jumps in oil prices because Iran, of course, is a big distributor of oil, not to the US necessarily, but to the world overall. You've seen oil increase by about 15-20% over the last week, and we'll touch on it a little bit more when we look at what the economy is doing here. But that is the primary market position that you're really seeing a change in right now, big moves in the oil markets. If you start seeing the longer dated contracts, basically people are pre-purchasing oil, right? So if they're purchasing longer dated contracts and you start seeing those increase significantly, then we're going to revisit this and maybe come with some other implications to portfolios. But for right now, primarily just focusing on that. So Jake, those are my thoughts. Anything to add to that?
Yeah, I think anytime we have something like a shock like this, you start to see some movements as retail investors, institutions are kind of repositioning, trying to put on some short-term trades, right? A lot of times we see safe haven assets like bonds. Those tend to rally because there's more investors pouring in there and maybe trying to get out of risky assets at the margin. I mean, these are things that obviously we hope that this conflict gets resolved in a short time period. But typically with these trades that we see within financial markets, they tend to be short-lived. And yeah, we would just stress that, don't let that break you from your long-term plan that you're on. I think, Joel, you hit it on the head. I think oil prices are going to be the largest, volatility metric that we have to deal with, and potentially, how that seeps into inflation. I mean, these are things that we'll get into as we talk about the economy. But I think that's really well said. Why don't you, Joel, kick us off into the market start that we've seen? I call it a divergent start to 2026. I mean,
Yeah.
if you look at the 6 different stock indexes we have listed here, you see that 2 of them are in the red to start the year. One of them is essentially flat, and then 3 of them are positive. So a couple things to kind of note here. International continues to outperform domestic stocks. This is certainly was consistent with our view that we had coming into the year that international had some tailwinds in terms of a weakening U.S. dollar, some stimulus packages that's going on across Europe, and that certainly has continued the international markets to do well this year. We're a little bit surprised maybe by the magnitude, right? As international stocks already up 10%, and we're seeing domestic stocks, not really do too well. I think the other notable trend to look at here is the difference between growth and value. We've got 2 lines, two metrics here. The pink line that you'll see, that's the S&P 500 growth segment, and then the brown line there is the S&P 500 value segment. And what we're seeing there is the growth stocks are down 3% to start the year, and value stocks are up almost 5%. And so that shows you, I mean, this is a strong reversal from the trend that we've seen over the last, 2, 3+ years, really since COVID, where growth stocks have strongly outperformed value stocks. Again, I think, when we look at this chart here, this is why having a diversified, well-balanced portfolio really does work. It might not work, or it might not feel great in markets where, one index is just leading the way and crushing everybody else, like we saw with big tech over the last couple years. It doesn't feel great in those environments, but when you start to, see some more breadth within the market, some different asset classes doing well, and a reversal from previous trends, that's where, you really feel good about having a well-diversified portfolio. Joel, anything that you want to hit on here as we look at how kind of the markets have evolved in the first 2 months?
Yeah, if I had to sum it up, I'd say valuations. When I look at this chart, it just speaks to valuations mattering at the end of the day. You will have certain periods of time where the markets are bid up and valuations kind of go by the wayside as growth continues to expand and such. But then you do hit these pockets where valuation comes back to matter again. And that's where you see the international markets coming 10% year to date after a 30% 2025. It's valuation driven. The international markets have been more cheaply valued, or lower valuations than domestic markets have been, especially over the last couple of years. That's historically been true. But even on the value and growth domestically, like you were just talking about, growth, we've been talking about this for at least the last 18 months about valuations being stretched, about being careful where you're putting that next dollar. And you're seeing that, and that's the reversal you were just talking about, which is the value side. The valuations in the value stocks made more sense, and that is where you're seeing capital flow right now. And that's what this chart says to me, is that valuations still do matter, which as fundamental investors, you and I, Jake, it's good to see some semblance of that coming back to the markets here. So let's also jump over and take a look at just a quick look at the yield curve here. Not a major change. So it's still a very healthy yield curve. Our 2 and 10-year spread is still positive, which is what you're looking for. We've seen some minor movements on the front end of the curve. Nothing really to talk about here. With what's happening in Iran, we have seen a slight increase in yields in the short term here. Again, I don't think that's structural. I think that's just trading, like Jake was talking about a little bit earlier. We're keeping an eye on this still, especially as we get the change in Fed president later in the year. I think that's just about a month or so away here. And so that's going to be one of the big impacts on the yield curve moving forward. But for now, this is telling us that the economy is healthy, and that really bond traders have a relatively good feeling about the bond market overall, and that's why we're seeing 10 and 2s are healthy, and the 30 years even getting to a place where it's a little bit healthier as well. So Jake, anything to add about our yield curve here?
No, I think you hit it on the head. I think as we get into the next slide, really looking at the economy, some of the indicators, you probably want to spend some time here. The first one, in terms of key economic data, we added in oil prices, which I think is really, really timely. I think if we look at the trends here, the 1 year doesn't look all that interesting, but certainly over the last 3 months, oil's up about 13%. most of the increase coming off the heels of the Iran conflict. I think, in my view, the concern of a prolonged conflict in the Middle East, from an economic standpoint, of course, centers around energy supply disruption. I mean, Joel, you talked about how Iran does produce, a good amount of oil, maybe not to us, but, they do supply it to China, for example, but
Mhm.
also the Strait of Hormuz, too, which is the transit source of about a fourth of the world's seaborne oil and liquid natural gas exports. If that is sort of taken offline for an extended period of time, I mean, that could really cause a lot of disruptions. And, not that we're forecasting that or anything, but I'm just thinking about some of the tail end risks that could come from this conflict, and energy supply seems to be kind of near and dear. And we think about kind of the effects that has on corporations. That's a key input or a key cost for a lot of different companies. Airlines, of course, comes to mind, but also when we think about everyday consumers, what they pay at the pump, that comes into effect too. And as if we see some of those prices start to build up, that could be inflationary, and it's probably not as sticky as maybe different sources of inflation that come from maybe wage growth or real sticky supply chain disruptions. It could be a blip that we see, where inflation on its kind of path down to a 2% target for CPI could, present some challenges there. And also on consumers, we think about wallet share a lot. If the consumer's paying more at the pump and more for airline tickets and different things like that, they might not be able to have some, discretionary expenditures like they would have kind of before those price increases. So that's what I'm kind of thinking of there. Inflation's another one that, we have to talk about. And I think if we look at over the last year, CPI is nicely trending towards that 2% target. However, along the way, we saw kind of the deflationary effects from energy come into play. So certainly, it seems like, and even before this conflict, we thought that, hey, energy, it's bound to kind of go to the other side at some point. You can't just have energy prices coming down forever. So that's one that we're looking at too. Loan delinquencies is another interesting one. Joel, what kind of speaks out to you with this chart?
Yeah, you just led me right into it, which is the loan delinquencies. This is something that we've been talking about during these presentations for since we started them, which is just the health of the consumer. And this is one that leads you to believe that maybe there is some weakening on the consumer side. Loan delinquencies up to about 1.5% now. You see from a year ago where we were down about 1.2. So that does point to a weaker consumer in the short term. And when loan delinquencies go up, that's something that we have to keep an eye on. But the good news is right now, looking across these economic indicators, that's the only one that's flashing red to us as far as the way that we scale these things. I think your comments around oil, very pertinent. You'll notice that this was run as of the end of February, so we haven't captured the short-term impacts here. So we will definitely see that when we rerun this later. That's one we're keeping an eye on. It's an oil-driven economy still, so this is going to permeate into all aspects of the economy. And so we're hoping that that does not have those long-term sticky effects that you were just talking about. And then one of the biggest ones here for me is actually housing starts. This one was a little surprising to me, is that's actually moving in the right direction here. So we've seen an increase of about 6% over the last 3 months in housing starts. And versus a year ago, we're still down. So that's primarily driven by the higher 30-year mortgage rate. With the interest rates coming down over the last year or so, you've seen the mortgage rates come down as well. I think we're right around 6 now, which is great news. Still not the 2.5 so that some of us remember from from a few years ago that we would all hope we would go back to, but still, at least that's more palatable to homeowners. And so I think we might be unlocking some home ownership here, and that's actually one of the next things that we want to dive into is housing actually starting to heat up? So what we're looking at on the left side here is that 30-year and the 15-year mortgage rates. And I think this is going to help consumers improve overall and hopefully help with the overall loan delinquency as well. But interest rates starting to come down and starting to get to a normalized rate here. Like I said, about 6% or so on the 30-year. If you're going for a 15, it's about 5.5%. You see that that's down from a high of 7.8%. And that was just a little over a year ago. So, of course, housing starts would not be as high back then. And so we're moving in the right direction as far as housing goes. The interesting chart to me is over here on the right. So with housing starts, what we're also seeing is these builders offering a ton of incentives to people to move into these homes, whether it's buying down their interest rate, whether it's perceived upgrades to the home that they're building. It runs the gamut of what these folks are offering. And we did not see that back during the 2020 housing boom. It was a much more competitive market. People were bidding up the lots. I mean, it was just such a different environment that we're now getting to a much more normalized one where they're having to compete for these buyers, and they're doing it through incentives and not through the reduction in home prices. So it's been working because on the right-hand side, the two lines I want to make sure we focus on are the orange and that blue line. So the blue line is existing home sales. That is down 10%. So existing home sales are down 10%. So that could be a couple of things. We don't really know for sure, but I think that's two things. One being people still have 2.5% mortgages. So they're just not putting those homes on the market. But then B, it's the competition from the new homes. And if you look at the new homes, which is that orange line there, that's up almost 16%. And I think that that is primarily being driven by incentives. But at least we're starting to see people get back into homes, and home affordability is still high. So it's something that we have to keep in mind when we look at those loan delinquencies is, are these people just getting in under these teaser rates? And is this going to cause a problem in the future? Or is housing actually starting to heat up? And this is something and a trend that we're going to continue to see from the consumer moving through 2026. Home ownership is good for the economy overall, so we're happy to see it, but we just want to make sure that we're doing it in a healthy way. And so, Jake, any thoughts from you on housing?
Yeah, one metric or one ratio that I think helps, just as another data point too, is called the price to rent ratio. And essentially, what it does, it takes the median home price, divides it by the median annual rents in the market, and that currently is above 23 times. And so if you take that ratio and flip it overall, it can be seen as like a rental yield. And so as that ratio gets larger and larger, or in other words, as the median home price continues to climb and rents don't really move that much, that would drive that ratio higher. It would decrease the rental yield figure, which is right around 4.25% right now. That's meaningfully lower than mortgage rates. And so what it suggests is that the financial case for buying is versus renting is still somewhat weaker unless you expect maybe some appreciation within the house, or you have a very long hold period as well. Again, this is not a hard rule or a law of finance or anything like that, but just something that, as we look at renting versus buying, rents have come down as well. And so that's another figure that home or potential homeowners are choosing between, like, hey, I'm getting maybe some rent concessions, or it's still relatively cheap. Mortgage rates have come down, but it is still higher than it was, over the last maybe 10 years or so. And so you're really just having that struggle still. And maybe that's sort of leading to this housing freeze that's starting to thaw, but hasn't exactly broken yet. And so I think we're certainly moving in the right direction. As Joel mentioned, home affordability is improving. So these are all really great signs to see. I think that, potential home buyers are still having to struggle between, hey, do I just continue renting for another year? My rent's pretty cheap and mortgage rates might just continue to fall a little bit. They're feeling a little bit uneasy. But Joel, to your point, the new building that we've seen coming online here in our area, at least, they are getting very aggressive. And so to your point, if you're thinking about moving into an existing, home versus a new build, they're certainly making that comparison more difficult, especially newer home, warranted, all that, and they're buying down your rate. I mean, there's a lot to like there, and a lot of supply that's still coming online, at least in our area here. But renting is still relatively attractive right now. I think we'll need to see rates continue to come lower a little bit, or maybe start to see home prices fall a little bit more before those who are renters are finally ready to take the plunge, which I think is it would be good for the economy overall. As people buy homes and they move into them, what do? Well, they go and they buy furniture for homes. It really is a stimulative function to our economy, and one that we don't want to see a frozen housing market anymore. And so, yeah, last point, we're getting there, but these things take time.
Absolutely. Absolutely. All right. So, Jake, I'll let you lead this one here for us. A lot of earnings, a lot of earnings. Still more to come, but basically, for the most part, we're kind of almost through earnings season, this year-end Q4 earnings report. So, kick us off. What did we see in February from our companies?
Yeah, I try to give a little bit of a mixed bag here in terms of companies, but certainly some are more notable than others. Starting with Nvidia. I mean, Nvidia is kind of the one company I think that the market kind of holds its breath for a little bit when it's time for them to announce results. And for good reason. I mean, there's just so much hype going on with Nvidia. Their expectations are sky high, and they come in and then they beat those expectations. And then, the market chews on it and then sometimes rewards them, sometimes they don't. And so this one, what NVIDIA saw was they delivered earnings that beat expectations. However, investors, they really grew nervous about the sustainability and how these earnings translate to future growth. So despite those great results, the stock fell sharply. Really, concerns that the profits that they generated really just weren't enough to justify the valuation. Kind of a classic sell the news reaction. However, it is something to be said that, especially for a company as large as Nvidia, growing as fast as Nvidia, it's not something that we can just ignore. I mean, it's not super crazy for a small cap company or a biotech company with some emerging drug that's going through the pipeline. They might have blips of being able to grow revenue close to 100% on a year-over-year basis. We have to remember that Nvidia posted about $70 billion in revenue for the quarter and $43 billion of net income. And for them to be growing that amount, it is incredible. And not only that, but the economies of scale that Nvidia has just means that as their sales increase, they've got operating leverage to enable just margin improvement across the board. They saw net profit margins increase from 55% call it last year to 63% this year. I mean, the fundamentals of NVIDIA are extremely attractive. There are still risks. Right now the market's chewing with this AI phenomena risk of, these hyperscalers like Amazon, who we'll talk about. Hint, hint, they got punished for continuing their capital investment cycle. And so the market's maybe thinking at some point, these companies that keep getting punished for investing in new NVIDIA chips, at some point they're going to have to, tamper that down. And that's going to affect NVIDIA's future earnings. That's what the market's dealing with. So that's what kind of led to the reaction after the market. Amazon was pretty similar. I mean, there's a lot of constructive feedback from the analysts who follow Amazon. For example, they noted that this is a company that has really strong growth and a high margin segment like AWS. That's their cloud service, and also their advertising business too. That's great. The bad is that they had a substantially higher 2026 capital expenditure guide, which was driven by AI demand and infrastructure scale. And so again, those questions are being asked like, is that going to actually lead to improving profitability down the line or not? And the skepticism is really proving to be true. I mean, Amazon was down, I think, over 7% after their last earnings. Yeah, at the same time, they had record AWS backlog, triple digit growth and custom silicon that they're having and better pricing. There's just so much going on that was good for the fundamental business of Amazon. Yet the skeptics, arguing that maybe they're losing ground to Microsoft or Google. And is it really necessary to keep this aggressive investment cycle going? I mean, these are hard truths that Amazon has to face. And so they were down post market there. Salesforce, another one that we've talked about a good bit, very negative price action this year. Same with last year too. And right now, Salesforce as a software company is dealing with the market just believing that AI will erase any and all need for software. I mean, that's what it seems like. A lot of these software names just in very, very big corrections right now because of that. The stock was down after their earnings, but again, they had very good results. Revenue was up double digits, earnings beat expectations by 25%. But I think the big one is that they announced a $50 billion share repurchase program. And these repurchase programs often reflect management's confidence in the intrinsic value of the company, maybe thinking that they are undervalued. But it can also signal that the company's entered into maybe a mature, maybe more mature free cash flow phase where returning capital, is competing favorably with reinvestment. And so in Salesforce case, it appears to be both maybe a valuation supportive move and evidence of this capital discipline that management's starting to show, something that we welcome as investors as well. And then lastly, AstraZeneca, kind of the black sheep here. They had a good reaction. We had one of those. But as we think about healthcare companies as a whole, this is a segment that has underperformed these technology or stocks like Nvidia, Microsoft, Amazon. At the same time, they've just continued to do well and just be consistent. They had total revenue growth up in the high single digits year over year. Earnings growth was a little bit better at 11%. If you look at their product growth across oncology, cardiovascular, respiratory, rare diseases, they've really executed on all of those crucial product lines. And they have a portfolio of 16 what they call blockbuster medicines. So the pipeline is really strong for AstraZeneca. It's something that we're very excited about, even as they do have headwinds they're dealing with right now, such as like the loss of exclusivity on a couple of key products and pricing pressures in China as well. That factored into the outlook, which still came out to be pretty strong guidance looking forward. So AstraZeneca, one of those names, they're an international company, trade at a lower valuation, have a strong dividend, and we're excited about these companies, especially as the market's having increased skepticism on these AI and technology companies.
Great summary. Yeah, I know it's been a busy season. It's been interesting to watch. I know when I'm looking at these reports, I'm looking for these management teams to be good capital allocators, just like my clients expect me to be with their planning. Where should that next dollar of investment go? And you're seeing disparate strategies across these firms. Amazon very much in the capital expenditure, still trying to keep up with NVIDIA chips and all their distribution warehouse. I mean, just very capital intensive still to this day versus Salesforce. And I think you hit the nail on the head there. Maybe this is a software company that is going from hyper growth where we were just a few years ago, and every dollar was expected to go back into R&D and just developing out their product, to now they're looking at their share price, which is significantly depressed over the last 18 months, down close to 50%. Could be a little wrong on that number, but it's heftily down. And they're looking at that saying this might be a good opportunity to retire some of those shares. So very different strategies between all these companies. And it's one that we go through each quarter to make sure that if the investment thesis changes, we're changing right along with it. But of course, we're long-term buyers of these companies. They're all great companies, and it all just comes down to the fundamentals at the end of the day for us. So great summary there, Jake. And sticking with Salesforce and how AI is impacting it, I will leave us here before we jump into our Q&A with a quick teaser for what's coming up in April. AI is everywhere. It is expanding rapidly. We are figuring out ways to integrate it here at FourThought already. It is these models are changing on a daily basis. It's incredible the speed of adoption and also improvement that these models are going through. And so Jake and I put our heads together and we said, you know what, let's have a fun presentation in April, and we're going to focus entirely on AI. We're going to explain where we are today with these models, what they're looking like, what risks lurk in your portfolio, kind of like a Salesforce. Maybe that might make another appearance in our presentation next month. But talking about some of the companies that are publicly traded, some of the companies that are even privately traded, maybe, and so walking through what the investment landscape might look like and where we see the future going. Right now, the future seems to be about 4 days from now, and then it changes again. So just talking about what AI might look like. So Jake, anything for people to hopefully join us in April?
Yeah, I think it's going to be a really great presentation. This is a a topic that we get asked a lot about from our clients. So we hear you loud and clear. We want to take some time and really get into the weeds a little bit more. Exactly, what technology are we looking at either within our portfolio companies or kind of right, along the journey here. And I think it'll be great to really get into the nitty gritty and what AI actually means and what it's enabling companies and business owners to do. So really looking forward to that conversation. And so yeah, make sure that you don't miss the April presentation there.
Yep, and great segue here. We're going to move over to our Q&A session, folks. So thank you so much for joining us. Please invite friends, family, whoever you want. Jake and I love doing these. The more participation we get, the more enjoyment that we have doing these for you. So we'll move over to Q&A and hope to see you in April. All
All right,
righty.
Joel,
Yeah.
excellent presentation there. And we got a question here, and Joel, just on time, we did go a little bit over there, so we'll get through this. The first question that we have here, Joel, if we rewind the clocks back a month to our February review, we talked a good bit about gold, silver, some of those hedges, and
Yeah.
the question that we got here is over this past month, we've seen gold come down a little bit and crude oil is now going up. Could you kind of walk us through the dynamics of what's kind of driving that?
Sure. Yeah. So I think we did a good job of touching on with crude oil exactly why that's happening. You've got the war or the conflict in Iran is really what's driving that move up in oil prices. Plain stop. So that one's fairly easy to explain, at least in the short term. We'll see what happens longer term, whether or not that's a persistent thing, sort of like we talked about at the beginning of our presentation here. On the gold side, that's a little bit more tricky. We did a good job, and that is available still to folks who missed last month's talking about gold and silver. Frankly, I think people are might maybe just be tired of the trade. A lot of this has been baked into that price. So gold is a place where people like to put money when fear increases, and people have been fearful for the last 18 months, really. And so that's why you saw the big spike last year. And moving into this year, it's kind of cooled off because it may have already been baked in. At least that's what I'm seeing. And so people might be a little bit more hesitant to buy into these prices versus where they were last year. Again, at the end of the day, gold's just a commodity. It's only worth what somebody else is willing to pay for it. So even though we've seen fear relatively increase in the short term, gold hasn't reflected that. But we'll continue to watch it. You saw silver kind of spike last year. It's doing sort of the same thing. But Jake, anything to add there? Any conflicting thoughts to that?
No, I agree with you wholeheartedly. I guess just to summarize it, oil is much more, supply and demand driven in that we rewind the clocks back to COVID. Nobody was traveling. Nobody was, so the demand for oil, gasoline, diesel, fuel was lower, and so they kind of had the same supply, and so you kind of saw the price decline for oil there. Now we're looking at a period where the supply of oil might be shocked to the downside because of this engagement of what's going on with Iran. We mentioned that kind of 20% of the world's oil moves through that region there. So that started to see that shake up a little bit. Whereas gold, on the other hand, really behaves more like a financial asset. Of course, it is at the end of the day supply and demand driven, but the key driver there would be especially around interest rates, strength of the dollar, and kind of investor sentiment as well. And they tend to build up gold when they're not feeling so great about the market. So they are a little bit, different strings pulling on those levers there.
Mm-hmm.
And Joel, we got one more question here that we'll take really quickly. With this war that's going on, have you seen kind of some buying opportunities in good companies that have taken a dip that have opened up? What's kind of your thoughts there on, let's just take the overall broad stock market and its reaction to this conflict?
Yeah, let's break it out. I think honestly, the stock market hasn't reacted to the conflict. You've seen volatility, but we have not seen large dips. There's a couple of companies, but nothing really across the board that would say, hey, this is a massive buying opportunity. We're looking at diving in, related specifically to what happened over the last weekend. Okay. But we have seen a lot of volatility for certain companies around their earnings. Again, we talked a little bit about that as well. And absolutely, that's opened up buying opportunities. one of the things that we've been harping on during these conversations is there is still time and places to put money to work in the market, even though the talking heads on TV are talking about the market's overvalued. We've had huge run-ups the last 2 years. We're in for a 3% over. You've heard all of the stories, but that doesn't mean individual companies haven't been attractive through that same period of time. So yes, there absolutely are still buying opportunities. We are still putting money to work for clients when we see those opportunities open up. But again, I haven't really seen anything directly related to companies that I want to own directly related to this war yet. Again, there's a tail risk there that might open up further, but those are sort of my thoughts. And Jake, I'll throw it over to you for any closing thoughts on that.
No, I really couldn't agree with you more there. I guess, if we think about it being kind of Publix, like your supermarket, that's kind of the market. And folks might say, hey, Publix is just expensive, right? And overall, that might be true. But at any given day, you walk in Publix and you see things that are on sale. You see that they've got some BOGOs going on. And I think that holds true with the stock market overall. I don't think we've seen market reaction to this conflict that has presented any buying opportunities. But certainly on a stock by stock basis, we've seen some big reactions around their corporate earnings, just as Joel mentioned. So that's how I always keep it in mind there too. And there hasn't really been a disruption in typical companies that we invest in their businesses either to kind of warrant any sort of shock. So yeah, I couldn't agree with you more, Joel. And we're running up on time. That's a couple questions that we had there. Why don't you take us home, Joel?
Yep. Just as a reminder for those who are clients, Jake and I, we're involved in the investments all the time. When those opportunities are opening up, we're doing it for you anyway. Even if you don't hear from us, we're always engaged in the markets. And even during, in between these presentations, we're always looking at these things and moving money around for those clients who are working with FourThought. And if you would like to work with FourThought, we'd love to hear from you. We'd love to see you at next month as well for that AI presentation. We're really looking forward to that one. Might even have some special guest speakers from FourThought. Give Jake and I a little break there and hear from some other voices around the firm. So, looking forward to seeing everybody next month. Thank you so much for joining us, and we will see you again soon.
All right, take care.